Why rising interest rates could trigger the next credit problem. Imagine borrowing money for 30 years and discovering that the cost has climbed to levels not seen in decades. That is essentially what is happening in parts of the global bond market today. And while it may sound like a concern reserved for economists and Wall Street traders, the consequences reach much further. Long-term government bond yields have been climbing across several major economies. On the surface, this looks like just another financial statistic scrolling across a news ticker. In reality, it influences everything from government financing costs to corporate borrowing and investor confidence. But the biggest story isn't simply that yields are high. It's what those higher rates are doing behind the scenes. Businesses that borrowed heavily when money was cheap are now facing much larger interest bills, especially those with loans tied to variable rates. Some are beginning to struggle, and pressure is building in corners of the credit market that rarely make headlines. To understand why this matters, it's worth looking at how bond yields work. Bond prices and yields move in opposite directions. When investors eagerly buy bonds, prices rise and yields fall. When demand weakens or investors require more compensation for risk, prices decline and yields increase. Several forces can push yields upward: tighter central bank policy, persistent inflation, growing government debt issuance, or reduced demand from major institutional buyers. Whatever the reason, the outcome is the same. Borrowing becomes more expensive. One area feeling that pressure is private lending. Many companies finance themselves with floating rate loans, meaning their interest costs automatically rise alongside benchmark rates. What once looked like manageable debt can quickly become a major financial burden. Some lenders have responded by restructuring loans rather than recognizing immediate losses, allowing unpaid interest to be added to the outstanding balance instead of paid in cash. While this may delay defaults on paper, it does not eliminate the underlying financial stress. As more debt approaches refinancing over the next few years, investors will be watching closely to see whether today's accounting solutions can withstand tomorrow's economic reality. Numbers on financial statements can be adjusted, but the fundamental economics of repayment cannot be avoided indefinitely.